Welcome, and thank you for tuning in. You're listening to the Beyond 50 radio program. I'm Daniel Davis. On the program today, we're going to be helping those of you out there who want to negotiate the world of getting money to work for you. That is, getting money to work for you in such a way that spends off passive income that in your later years you'll be able to find yourself sitting with a sense of security and perhaps financial choices that you didn't have available before. On the program today, we're going to be talking about dividends. That is, dividends that spin off from companies that you decide to invest in. Our guest is going to help us learn how we can create an action plan for spotlighting attractive dividend-paying stocks while isolating those where dividend cuts are most likely. He also offers a step-by-step way on how to combine this new strategy with other investment tools to improve your odds of finding the best stocks for dividends and growth. We'll also learn how to avoid pitfalls, find opportunities, and construct a portfolio that generates big, safe dividends through what is known as Big Safe Dividends Formula. He is the CEO of Horizon Investment Services and an investment advisory and money management company, and also the CEO of Horizon Publishing, which is a publisher of investment newsletters, and he's also Horizon's flagship publication, Dow Theory Forecasts. I'd like to welcome to the Beyond 50 radio program today, author of the book, The Little Book of Big Dividends, a safe formula for guaranteed returns, our guest, Charles B. Carlson. Charles, welcome to the Beyond 50 radio program.
Thank you for having me, Daniel.
Now, you talk about what is known as drip investing. Tell us how you got started in this and what this is exactly.
DRIP investing, DRIP being an acronym for Dividend Reinvestment Plans, is a form of investing where you're dealing directly with companies to buy their shares of stock directly from the company. Now, I know that may sound to a lot of your listeners as something that can't be done, but the reality is there are well over 600 to 700 publicly traded companies, many big names, which I'll mention in a moment, that allow investors to buy stock directly from the company. You do that in a number of different ways. You can send money directly to a company, or usually it's an agent that administers the plan for the company. These investment amounts can be oftentimes as little as $50 to $250. If your amount isn't enough to buy a full share of the company's stock, you can buy fractional shares of stock, and those fractional shares are entitled to a fractional part of the dividend. And best of all, in many companies, you can make these purchases with little or no fees. So it's a very easy, very forward way for anyone to participate in the stock market in dollar amounts that make sense for their own pocketbook. So I basically kind of got turned on to dividend reinvestment plans back in the late 80s when I used to review these plans for one of our newsletters, and it was hard to believe that, boy, with $50 or $200 or $10, you could go out and buy America's finest companies and do it directly and do it and pay very little in fees. And consequently, I wrote a book on it in the early 90s called Buying Stocks Without a Broker, and later started a newsletter discussing it. So, they're wonderful plans for investors that are looking for a way to kind of break down the door of participating on Wall Street and doing it, again, in dollar amounts that make sense for their own pocketbook.
Now, obviously, when you say the words Wall Street or stock market, there are a lot of people that shudder, especially after the most recent recession that we have gone through. And obviously, we keep hearing bells and whistles that tell us it's going to probably happen again. And then you hear all the stories about, I had all my money into the stock market, and I was all set to retire. It's always the same story to me. And the next thing you know, the stock market took a downturn and I lost it all, and now I've got to start all over again. So let's talk about drip investing when it comes to risk, I suppose, for listeners out there who, they think this is maybe a direction they want to go, but they get concerned about something like that.
Well, all dividend reinvestment plans are different vehicles by which you purchase stock. Just because a company stock offers a dividend reinvestment plan doesn't in and of itself make it a good investment or a bad investment. So you still need to do your homework. You still need to choose companies and stocks that you think will appreciate over time. What a DRIP does, however, is provides a way for you to maybe invest in that plan in a way that makes more sense for your risk parameters and also with the dollar amounts that you want to spend. Just as an aside, the stock market certainly has risk, and we've seen that rear its ugly head, a couple of times in the 2000s. And if you go back through history, there have been some rocky market periods. But I also think it's important to remember since 1926, the stock market on average has gone up 3 out of every 4 years. And I still believe that for investors building wealth, it still represents the single best opportunity that the average person has for building wealth. Yes, you may have to ride through some ups and downs, and yes, if you're somebody who's approaching retirement or in retirement, you need to kind of calibrate how much risk you want in the market. But nevertheless, I'm not sure at any age investors shouldn't have at least some of their assets in the market. Obviously, if you're 85, I wouldn't recommend having 100% of your assets in the market. But at the end of the day, the biggest risk people run from an investment retirement standpoint isn't a bear market. It's, can my spending fend off the effects of inflation over time? That's a really huge thing. I mean, inflation is really kind of enemy number one for retirement and for cash flow. If inflation were to average 3% a year, we've been under that. But if it were to average 3% a year going forward, in 25 years, basically, your spending power gets cut in half. So, if you have a cash flow of, say, $50,000 today, and you have 3% inflation for the next 25 years, that $50,000 25 years from now is only going to be worth $25,000 because of inflation. So, stocks, and particularly dividend-paying stocks, do provide a way for investors to kind of combat the insidious effects of inflation. So, stock ownership, I think, is important. How much of stock you own obviously needs to be calibrated for your risk and your age, but it is a worthwhile way to build wealth and maintain it.
Now, what are the ways that you determine risk when it comes to companies that offer dividends?
Well, there's a couple of ways you can look at risk in terms of companies that offer dividends. The first is the risk of the actual stock, fluctuating and going down, and there's two aspects of that risk. There's the company-specific risk, and then there's just general market risk, since most stocks will be influenced by the broad market. Dividend-paying stocks, on average, historically, and I say both of those qualifiers because they may not hold up in every single market environment, but on average, historically, companies that pay dividends have a lower risk profile than companies that don't pay dividends. And when I'm talking about risk in the stock market, risk really means volatility. For example, if you're somebody who's 72 years old, what the market does over the next 12 months is going to be much more relevant to you than somebody who's 25 years old, because the 25-year-old obviously has a long period of time to make up for kind of a multitude of investment sins. So this notion of volatility is really kind of a risk measure when you're looking at stocks. Again, companies that pay dividends historically have a bit less volatility than companies that don't pay dividends. The other benefit is that with companies that do pay dividends, you don't need to generate all of the return of an investment simply from a capital appreciation or a stock going up or down. You can generate return through the dividend flow that comes back to you. And then finally, if you're in things like dividend reinvestment plans, or you can do the same thing with a broker, you can take those dividends that companies throw off and reinvest them back into the company to buy additional shares if you don't need the cash flow to pay bills and things like that. And what that does is it allows you to kind of what's called dollar cost averaging, where you're accumulating and investing over time. So hopefully you're kind of smoothing out the highs and lows in the market, and that's another way to kind of control risk in investing.
Wow, it almost sounds, pretty easy for people to approach this here, and certainly as people look through your book, when it comes to getting a lot of these questions answered in the Little Book of Big Dividends, one of the questions, I guess, would be also to decide, What is the process like when you choose a dividend stock to invest in, and then you decide to call the company that's offering it?
Well, the process is kind of twofold. Obviously, you kind of hit the nail on the head. The first is selecting and trying to pick stocks that you want to own that pay dividends, where the dividend is sustainable and hopefully is growing on a regular basis, and then making a determination of how you want to purchase that stock, whether you want to purchase it through a broker or if the company does offer a dividend reinvestment plan, purchasing it through the plan. My book, discusses a number of different ways to look at companies that pay dividends and how to evaluate them, and we also provide kind of a formula for that. But one of the overriding things to keep in mind when you're looking at companies and their dividends and the safety and growth potential of that dividend is basically companies can only pay dividends in a sustained way out of the profits that they earn. That sounds kind of common sense, but a lot of people tend to forget that companies don't pay dividends. They can't fabricate them out of thin air. They can only pay a dividend if the company is generating profit and cash flow. So one of the things, a simple way to kind of look at a company to determine the quality of its dividend is by looking at what's called the company's payout ratio. And I know that sounds a little math complicated, but it's actually quite simple. It's how much of a company's per share profits, and you can look at virtually any publicly traded company to find out how much they make in terms of their profits per share. How much of those profits are they paying out in the form of dividends per share? So for a simple example, if a company is earning $2 per share in net income and they're paying out $1 per share in dividends, that's 1 over 2 or 50%. So they're paying out half their profits in the form of dividends. If you do that analysis on a company and they're paying out 99% of their profits are going to dividends, obviously that's a company that does not have a lot of cushion if their profits decline to maintain the dividend, and it's also barely any cushion if they want to increase the dividend. So, and these are kind of ideas we talk about in the book, and in fact, I provide a free website that people can kind of look at to learn these formulas, and actually where I compute them for you. That website is bigsafedividends.com. The actual process of joining a dividend reinvestment plan is very easy. All these companies have toll-free numbers. You would simply call the toll-free number, request the enrollment information. The company would send that out to you. You then would read the information, and that would have such things as what's the minimum investment you can make, what's the maximum, what are the fees, if any, etc. And then you would simply fill out the application form, include a check, mail it back to the company, and you're off and running. So they're very easy plans for anybody to participate in.
Now, you also talk about paying attention to picking dividend-paying stocks, but to do it not necessarily based on your needs, but based on their merits. Okay, give some clarity about what that means.
Yeah, too often when people think about dividend-paying stocks, they don't. What they're really thinking about are companies buying stocks for a company's yield. And for those of you, a dividend yield is simply taking the dividends and dividing the stock price per share into it. So, if a company is paying out $1 per share in dividends and it's a $20 per share stock, the dividend yield is 5%, 1 divided by 20. So a dividend yield is kind of akin, you can think of a dividend yield similarly to the interest rate you may earn at your bank. So, the interest on your savings account or the interest you receive on a bond, that interest rate, the equivalent in the stock world is a dividend yield. So my point is, when a lot of people think about dividend investing, they're really thinking about yield investing, and they're thinking about how much they need from their investments in terms of cash flow. So unfortunately, a mistake a lot of dividend investors make is zooming in on the highest yielding stocks because they may think, I have X number of bills to pay, so I need to make 5% a year on my money, and I'm going to get that all through the dividend. That's a mistake, because high yielding stocks, the highest yielding stocks oftentimes may represent the highest risk to the dividend. That's one reason why they're yielding what they are. The other issue is if you only focus on the highest yielding stocks, you really exclude the universe of stocks from which you're choosing from. So in other words, you're losing the power of diversification. You're buying a lot of stocks that are kind of the same stock, and they're vulnerable to a lot of the same factors that can drive those stocks down. So, the bottom line is it's better, we believe, it's better to focus on good quality companies where the stocks can show decent appreciation potential, that do pay dividends, but also, most importantly, where the dividend stream is growing. That is, I think, is really an important factor when you're looking at dividend stocks. Not so much what the current dividend yield is, but is this a dividend stream that can grow over time? Because a growing dividend stream, again, can really help offset the impact of inflation. If I kind of put it in these terms. When was the last time anybody got a 10% raise on their salary? Well, there are companies out there, and we talk about how to find them in the book, that will raise their annual dividend 5 to 10% per year. So it's almost like you're getting a raise on your income stream. And if you're getting a company where they're raising their dividend 5 to 10% a year, that increase in the dividend every year is really going to be a nice offset to any inflation that's occurring.
I think what's also great about what you talk about here, too, is that you bypass somebody like a financial planner or broker, and you go company direct, and you can see the advantages of creating a relationship that way. And one of the biggest ones, obviously, is that you avoid a lot of the fees, that usually get associated with somebody who does this for you.
You do. Before I kind of, I'm not trying to badmouth financial planners or wealth advisors or anything like that, and I don't. You're not either. And I think for some people that feel very uncomfortable doing this on their own, they provide excellent services. On the other hand, there are people out there that at least with part of their investments, may want to try to do it on their own. And these plans offer a very user-friendly way to do it. There are a number of companies that charge no fees to buy the stock in the plans. There are other companies that do charge fees, but those fees may be as little as $1 up to $5 per transaction. So they're pretty competitive when it comes to the fees. The other thing too, I might add is, all too often there are things in the investment world that are really framed as either or. Either you use an advisor or broker, or you do it yourself. Either you buy mutual funds, or you buy individual stocks. And it's almost set up as a binary decision. And I really kind of eschew that thinking. There are a lot of different ways for individuals to participate in the market, and you should take advantage of those that make the most sense for you. I personally, in some of my portfolios, I own mutual funds, and others I like individual stocks. I have probably 15 dividend reinvestment plans, but I also have brokerage accounts that I use to buy stocks, some that may not have a dividend reinvestment plan. My point is that, don't get kind of pigeonholed into this binary. It has to be one way or the other. There's a lot of resources out there for investors to take advantage of, and they should take advantage of that.
Now, does this formula also work well when it comes to choosing foreign stocks as well?
Yes, it does. The only problem, and actually, interestingly, there are many foreign stocks whose shares trade on the U.S. exchanges that do have dividend reinvestment plans, where you can buy stock directly from these companies through an agent the company hires to administer their plan. And that's one of the things that isn't very well known, that not just U.S. companies offer. And to give a flavor, I think right now, out of the 30 stocks in the Dow Jones Industrial Average, big blue chip names, I believe 25 of those allow any investor to make even their initial purchase of stock directly from the company. So we're talking about big blue chip, well-known companies. On the international side, there are probably 200 to 300 international companies, many big, well-known companies like Toyota and Honda and a number of the foreign pharmaceutical companies, and a lot of names people would know where you can participate as well in the direct purchase plans. The only a little bit of a hitch is that in terms of researching companies on the international side, sometimes the information flow is not as readily available as it is on U.S. companies. We do discuss in my book, international companies that we think are pretty attractive, and a lot of the same ideas in terms of analyzing the dividend, work for foreign companies as well as with U.S. companies.
Now, one of the ways, too, that our listeners can consider using this as well is that you talk about what's known as partial reinvestment option, which is offered by most company-sponsored DRIP programs. Tell us a little bit about how that works.
Right. As I kind of mentioned in my earlier comments that one of the nice things about dividend reinvestment plans is this power of reinvestment, and it's oftentimes kind of ignored or given short shrift. But the reality is if you are automatically reinvesting your dividends back in to buy additional shares of a stock, it really puts a part of your investment program on autopilot where you are basically investing over time, maybe during markets where you'd rather not emotionally, such as down markets. But the reality is if you're a long-term investor, taking advantage of down markets is really what helps build your wealth over time. But left to our own devices, it's very difficult to go in and buy stocks when stocks are falling. If you have automatic reinvestment, at least you're taking some of your money and buying stocks when they're down, and usually that's a rewarding thing. Now, what partial reinvestment is that these plans, many of them will allow an investor to carve out a percentage of the dividend flow that they want to have reinvested, and then a percentage of that dividend flow that they want to receive in a check. So if you're somebody, for example, that needs to have some of the dividends sent to you in cash to help pay your bills and things like that, but you also want to reinvest, you can have your cake and eat it too in these plans that offer the partial reinvestment, where you can determine, say, listen, I want 50% of my dividends to be reinvested, and I want 50% of my dividends to be sent to me in a dividend check. And these plans offer that type of flexibility.
I could see how that could really work to an advantage, especially like you said, when there's a downturn. And all companies have their times when they're operating at losses and their stocks are worth less. And that gives you an opportunity to buy those stocks at lower prices, because eventually, things like Coca-Cola, for instance, have been around forever. There are going to be those times that, they're going to be down on the bottom of the basement, and then other times they go through the roof. And when you're buying those things when they're down in the basement, then you get to enjoy the advantage of them going through the roof. And as you were saying, without having to be so invested emotionally on whether or not you should go in there and do that, it kind of goes on autopilot, as you were saying.
Right, and it's hard to help people realize this, but if you own stocks over time, the way you really maximize the ownership in terms of your profitability and your wealth creation is really taking advantage of the opportunities when stocks are down. What happens, and we're all humans and we all have emotions, is that, intuitively, logically, we can think that's the best time to buy is when stocks are down. The reality is nobody ever wants to buy stocks when they're down because
right.
The fear is they're down and they're going to get cheaper. Well, to have at least some piece, I'm not suggesting you have to have all your money on autopilot, but to have a piece of your money on autopilot that forces you to buy when stocks are down is a good thing. And with dividend reinvestment, you can do that. The other example of kind of this forced investing is a company's 401k plan. If you're work at a company that has a 401k plan and you're having your money pulled out of your checking account, out of your check each pay period to invest, that's kind of a form of this automatic investing. And yes, it doesn't feel so great during market periods where stocks are falling sharply. You feel kind of dumb, to tell you the truth. But, there has not been a downturn in the market that eventually did not resolve itself and go higher, even if you go back to, the last really major pullback in the market in 2008 into 2009, where stocks fell, 40%. Even after that, the market has come back, and the market, the Dow bottomed out around 6,600 in March of 2009, and now it's over 21,000. So, even in a once in a 70-year bear market, had you hung in there and hopefully bought during that decline, the Dow has more than tripled since that. So, buying during down markets is a good thing to do. It's very hard to do if left to our own devices. So having something like a automatic reinvestment of at least the dividend flow is a good thing.
And when you look back at the history of people who have made, quite a bit of wealth, especially, those are the ones that actually are buying into the market when it's going down or bottoming out. And then, of course, as you said, it bounces back and corrects itself, and there you go.
Absolutely. Now, one argument, and it's hard to refute, is somebody goes, "Well, I don't have any money to invest."
Right.
When the markets are down. Yeah. And that's, again, why having something set on autopilot, whether it's reinvestment of your dividends or having money pulled out of your check in a 401k or something to force you to buy, makes a lot of sense. But you're right. Some of the biggest fortunes in the stock market, were people that took advantage of significant declines in the market to put money in. So if you have the ability to do that, and again, I'm not saying it's easy. It's a lot easier to think you'll do that during strong market periods, and then when it actually hits, to actually do that, it's tough. But I have been fortunate that I have been doing dividend reinvestment for 25 years, and so I've had something in there automatically kind of funneling into the market every 3 months, and that has served me well, and I would venture to say it would serve any investor well who's looking to do this and do it over a lengthy period of time.
Now, we've also talked about what we want to take a look at when it comes to inflation and trying to stay ahead of that. And now, ultimately, as you were talking about, when we come to reinvesting, we decide, do we do 50% that gets reinvested back, and then do we take another 50% where we get a check? So what are things to consider during tax time, which is another area that we want to really alleviate a lot of our financial burden from, when you have to submit your financial records to your tax preparer about your dividend stock investments?
Well, that's a great question, and it's the tax implications of dividend investing and investing in dividend reinvestment plans are relatively simple, with maybe one hitch. In a given year, if you didn't sell any of your dividend reinvestment plans and you held them and you just collected the dividends, each of the companies every year will send you a 1099 form showing the amount of dividends that they either reinvested or sent to you. And that 1099 is similar to a 1099 that you would receive on any other income, and you would just simply give that to your tax preparer, and he or she would make a note of that and include those dividends on your income taxes. And by the way, if you don't get a tax break if you reinvest dividends as opposed to getting a dividend check. Either way, you will have to pay the tax on dividends that you receive, whether you're reinvesting them or taking a check. But again, it's pretty simple. It's you're going to get what's called a 1099 form showing the amount of dividends, and if you do your own taxes, you would just reflect that on your income tax form, and any of the tax preparation software such as TurboTax handles it, and it's very easy. Where a little bit of a hitch can come in is if you decided to sell shares in your dividend reinvestment plan, because as is the case with any investment that you sell in a taxable account. Now we're talking about taxable accounts, not retirement accounts or IRA accounts. In a taxable account, for any investment that's sold in a taxable account, the IRS will want an evaluation of whether there was a profit or a loss on that investment, and ultimately you will owe tax on that profit if you have a profit. Determining the cost basis, in other words, the basis for the stock to determine whether you made any money, if you have it in a DRIP, can be a little complicated. Not complicated, but it will require you to have maintained decent records. For example, if you've been in a dividend reinvestment plan for 5 years and you sell a stock from your dividend reinvestment plan. The IRS requires you to have a basis on that stock to determine whether there was a gain or a loss. And factoring in and calculating that basis is pretty easy if you've maintained good records. And all the dividend reinvestment plans will send you regular statements, including a year-end statement showing all of the activity in the plan. If you've kept those, it's a pretty easy process. If you haven't kept those, then you're in a little bit of a pickle, because then you have no idea what your basis is on the investment. So the tax implications, if you sell shares in a dividend reinvestment plan, do ramp up a bit and do require the investor to have decent record-keeping skills. If you have those records, and like I said, I've been in dividend reinvestment plans, some of them for over 25 years. If you have the records, it's a pretty easy process. If you don't, it can be significantly more complicated.
Well, I want to thank you for taking the time, Chuck, to join us here on the program. You've certainly outlined a lot of good reasons why people should pay attention to this, especially as a first course of action for people who haven't decided, to invest their money and they want to take a look at doing this, and it seems relatively easy to negotiate. Your book certainly outlines it for most people to begin doing their homework, to take those first important steps, and it helps them create new habits. New habits help us ask new questions. They also get us to see through the experiences life in a different way, where you get more excited. It was like I was telling my wife one time, and this was many years ago, you hear about investing or getting involved in something that creates passive income, and you think, oh, yeah, sure, that sounds great. But once it happens, you start looking for opportunities, and you start seeing more of them, of how you can actually experience more passive income once you have that experience. And this one here is the same way. When you start investing into companies through something which sounds relatively simple, which is a drip investing program, then you start getting involved and you start realizing as well that this is not only exciting, but it's interesting, and you begin doing your homework more and more about it, and that's the key, getting your homework done.
And you bring up a great point that is lost on a lot of folks until they get going. The hardest thing about investing is starting. Once you start, and whether you're doing that dividend reinvestment plans or whatever, the process does become a bit infectious, and it builds on it. And people always think, well, I don't have any money. Well, miraculously, if you start with just very little money and have the ability to invest that little money in good quality stocks, which you do in dividend reinvestment plans, I can almost guarantee you're going to find other monies to do this. All of a sudden, it's like, well, there was $20 I normally would put into that, and I'm going to put that into a stock now. And
there was the $100
it is a process.
Frappuccinos at Starbucks.
Yeah, exactly, and it becomes it's a process that becomes very infectious. And you're not going to get rich overnight. You're not going to get rich in a year. You're not going to get rich in 5 years. But I guarantee, I can guarantee if somebody sticks at this and does it for a while, they're going to feel a whole lot better off and glad that they did. And I might add, Daniel, if you can turn on, sometimes I feel like I'm preaching to the choir, but if you can turn on, perhaps your son or daughter, or more likely a grandson or a granddaughter, and get them involved in this process at a young age, and start to build those disciplines and that willingness to put money away, and get them involved and interested, you will absolutely change your life. You will change their life. And so many of us have so few opportunities to do that in anybody's life. And so oftentimes, again, the people that have the most time are the hardest people to get involved in this. But, the power of time is an amazing thing. And if you can get, a son or daughter or a grandson or a granddaughter involved in this, and it's a very easy process to do that with, you will absolutely change your life.
Yeah, that was much like I watched my stepfather, for instance. He started a business, and I thought, well, if he can do it, maybe that's something I should consider. And I keep telling people over and over again, especially people who work for other people, I said, first 5 years of starting a business, you'd be amazed at the tax savings you have alone as you reinvest your own money into your business to try to get it going. And, sometimes businesses don't work out, but you don't lose all the way around because you've always gained and learned something. Now, as a result, my own son automatically decided, well, I'm going to go ahead and start and be in business for myself as well. And he decided to do that without ever actually really working for anybody. So when you were saying, here is a habit you can pass on, it's pretty miraculous how that habit begins to, multiply. And I'm sure that his daughter, as she gets older, she's going to realize, maybe I want to start my own business. So now you just started generations of people who don't work for somebody else, but actually create jobs. And it's very, very exciting, especially when you talk about it in the realm of investing.
Exactly.
Mm-hmm. Now, Chuck, is there a website our listeners can go to find out more about this, how to get the little book of big dividends, things like that?
Sure. The website, and I referenced it earlier, if you go to bigsafedividends.com, bigsafedividends.com, and there you can look at the book. The book's also available on Amazon.com if people want to get the book. But at bigsafedividends.com, it's a free website, and what we have done is we have taken all the stocks that pay dividends out of the S&P 1500. So all dividend-paying stocks in the S&P 1500, what we've done is calculated their Big Safe Dividend formula scores, which are 0 to 100, with 100 being the highest possible score. And we've also included another scoring system that my firm has called our Quadrix stock rating system, which looks at more than 90 different variables and ranks those variables to come up with a score, again, a 0 to 100, with 100 being the highest possible score. You can see how all the dividend-paying stocks in the S&P 1500 rank at that website, and that's a website that's updated on a weekly basis. And again, it's free. So, there's good information there. It's a good source of research if you're thinking and looking about companies. And then finally, if you're looking at companies and wanting to know whether they have a dividend reinvestment plan or not, my firm has another website where we discuss that, and that is called the dripinvestor.com, dripinvestor.com. So those are, I'm biased, but I think those are two pretty useful websites, the dripinvestor.com and bigsafedividends.com.
Well, you've certainly given out a lot of great information for our listeners to actually get started with. And again, when you hear things such as, well, you want to avoid risk, well, the fact is when you hear a lot of people who have built wealth, they really say one thing consistently, and that is what you want to do is to learn how to manage risk. And obviously the best way to do that, do your homework, do your homework, do your homework. It takes work, but think about how much work it is to get out there for somebody else and not do any of this. I think that's
exactly.
a lot harder to do than it is to do this kind of homework here and learn how to take the financial reins into your own hand and guide your financial direction for yourself. Chuck, I want to thank you so much for joining us here on the program to talk about the Little Book of Big Dividends.
Anytime, Daniel. Thank you.
You bet. We want to thank you, the listeners out there. One of the reins you can get a hold of is to take the reins and go to beyond50radio.com. That is the number 50. We do encourage you to sign up for our weekly e-newsletter and stay up to date with what's going on in the world of Beyond 50 as well as upcoming programs. I'm Daniel Davis. Thank you for tuning in. This is the Beyond 50 radio program, and remember, live your day past halfway.